Hey everybody, it's Friday. Daniel Newman here, Principal Analyst at Futurum Research, Futurum Tech TV as I like to call it. And I'm doing this little monthly series here. I got Al Root from Barrons. Al, say hello to everybody.
Hello to everybody. Hi Dan, good to be here. I got dad jokes galore.
Oh yeah, we found that out together. We've talked for a number of years. Al's a pretty prolific writer over at Barrons, covers a lot of the industrial tech, but has a pretty strong background across the whole technology space. And so we had a great conversation. Most recently, we were both in Charlotte, North Carolina at Honeywell's brand new headquarters. They're doing a series of interviews disparately, including with CEO Darius Adamczyk. But then also we had a chance to sit down together. So actually the first episode of you and I in our random musings actually was kicked off on another channel, and we're going to have to publish that at some point. So, generally speaking, in the world we live in, Al, the newest media should go out right away. And so we're a little off on that, but the other one's pretty highly produced. It looks really fancy, and it's going to make this one look kind of meh as we sit here in our home offices. But good to have you back.
Good to be back. Always good to talk to you. Dan is always very helpful for a reporter or equity analyst to explain what's going on at sort of a industry technical level. Also very wise about the securities. Great to be a part of it. I was wearing a suit that first time. No suit today, but I did prepare. I brushed my hair.
I put my tech bro outfit on. I am wearing white shoes, all white, just so you know, because in case I don't show them. But sometimes I mix it up and I wear the black ones with the white bottoms because that's my other tech bro outfit. But I've always got the vest. This is Lulu, and when I can't pull off a Lulu, I grab a Patagonia just to make sure that I prove how techie I really am.
The tech bro, the tech bro, the Patagonia is really the hedge fund bro more than the tech bro.
Those guys aren't my friend right now.
They're definitely more West Coast tech bro.
Those
like the ultimate hedge fund uniform is the Patagonia vest with wood-bottomed expensive leather shoes.
And doesn't it actually, the vest, have the blood of retail investors on it all over?
That's what I think. I think the stitching is soaked in the blood of retail investors.
It's in the blood of retail and people's 401ks and all kinds of different growth companies. And actually, that segues us pretty darn nicely to today's topic. So what I thought, that we could talk about today, and I think you and I could both find some common ground here, is talking tech rec. Mm-hmm. And talking about, basically what is ahead over the next 4 or 5 weeks as earnings for tech come out.
Yeah, I mean, to start it off, the NASDAQ's on pace for its worst January ever, right? Depending on exactly where you look in the day, we're talking about a double-digit decline in January. The Dow and the S&P don't look much better, but rising rates, inflation fears have just destroyed tech. Now, destroyed is relative, right? We are so wimpy these days where like a 12% dip or correction, makes us, oh no, what's going on? But, underneath the numbers to a certain extent, it's actually a little worse than those 10 or 12% headline numbers, right? Like, again, we can get it exactly right, but generally, 50% of the NASDAQ's down 50 from its all-time highs. Now, it's a market cap weighted index, so really what goes on with Amazon, Google, Apple matter more, but it is pretty disastrous out there. And what it's leaving people, it's the classic, is this as bad as it gets? What is going to stop this? Is it some macro factor like interest rates and Chairman Powell at the Fed doing something or saying something? Or like earnings going to save us? Earnings did not save Netflix yesterday. That was not good for Netflix investors. So that's sort of the background of what's going on. And now I have to ask you. So do earnings save us all? It's going to be so good at Apple. So many iPhones have been sold that we're good.
I've got an opinion on that. I'm going to backtrack just a little bit while you sip your coffee, though, because I want to give a little historics here. You gave a great data point. Something around 50% of the NASDAQ or tech and growth stocks are down 50% off their highs. But you really have to look across the board here. The sell-off that we really are all feeling right now and finally starting to see the headlines pop on to Fox Business or CNBC, this has been going on over 2 months, okay? This is not new. And this, by the way, is not the first time. So we had a really nice rise for growth that happened mostly throughout the summer and into the fall. But around November, when Omicron hit, that's actually when you started to see a really significant sell-off in a lot of growth names. Now, there was a bunch of different factors. First, it was Omicron, sell. Then it was, well, we're doing end-of-year tax loss harvesting, sell. And then it's, we got interest rates rising, sell. And now we've got, well, it's all baked in, but, we're going to have some compression on valuation, sell. And you're starting to see these really nervy, kind of fuddy looking things. So you've got these two sort of, this entire continuum. You've got the 10 or so percent correction to the overall indice, which I think everyone for a long time said that needs to happen. But what I don't think anybody fully did expect, and I can say this as someone who's suffering this, whether it's Kathy Wood, as she's suffering this right now, but it's things down 40, 50, 60% with really no news or fundamental change. I cover more enterprise and big tech names, and we'll get to the Apples and these companies that have held up a little bit better. But I'm also, I invest personally. I like growth companies. I find interesting secular trends, whether that be iGaming and gambling, whether that's, gene editing, whether that's different innovative companies, fintech and disruptive. You look at companies like DraftKings that are down 70%, but I have not seen any fundamental difference in gaming and iGaming behavior. Yes, Kramer will come out and say, well, they're not profitable, but that's always been the story with growth companies. Yeah. They're growing really, really fast. You got companies like SoFi Bank or SoFi, now it's a bank. It's down 50% in the last 30 days. You've got companies, I'm just kind of trying to, kind of give some examples. Adobe, I just looked at Adobe off close to 40% after some really good results the past several quarters. NVIDIA, Al, is down over $100 a share off of its highs. And all they've done is break records over the last several quarters in terms of both revenue and earnings. So there's been no catalyst except for maybe the fact that we all know the market is future looking. And at the future looking, everybody thinks that interest rates and inflation are going to take the market down.
Yeah, I mean, well, to some extent, so now we have, to some extent, it's just the math, right? Discount rate rises, interest rates rise, discount rates rises. All of our speculative companies generate most of their free cash flow and earnings far in the future. You take that discount rate, you apply it to those future cash flows. A rising interest rate environment will take 50% of the, in some extreme scenario, 50% of the value off a company like Rivian, and it'll take, 25% off of the value of General Motors. General Motors doesn't grow. It generates free cash flow and earnings today. The impact of the discount rate is far more subdued or benign for old economy, established companies that don't need financing. And it's very severe for speculative enterprises, need capital, going to be profitable years down the road. One of the stats I like, little sub-sector stat. So EV companies with no sales, so Arrival, Lordstown Motor, Rivian, to a certain extent, Fisker Automotive, those stocks are down about 25% on average year to date, probably 30, depending on where we are today. Electric vehicle companies with sales, so that would be like the Tesla, NIO, XPeng, Li Auto, the Chinese automakers that are listed in the U.S., those stocks coming into Friday were down about 8% year to date. So you just see that is like, all that is no news. In fact, the only real electric vehicle, we've had 2 electric vehicle data points, but the best one was Tesla deliveries blowing away people's expectations. So all that's basically no news. All that is basically math of stupid interest rates rising. So yeah, that really is probably the biggest factor. And the move is probably too severe, but this uncertainty, right? Like, where do rates stop? Is the 10-year going to be 2.5 at the end of the year? Is the 10-year going to be where it was pre-pandemic? And it's this like, oh no, what's going to happen? Are we going to have 3 rate increases or 5 rate increases? And instead of thinking fundamentals, everybody's like honed in on Jerome Powell and inflation rates, and they all freak out.
But I also think the obvious thing is the people that are doing the most, they're most active in the market tend to make money in both directions. So a little bit of a correction is not a bad thing. Or it wouldn't be surprising when you're hearing from Bill Ackman saying, hey, I think the Fed should do a double half-point interest rate next in March. Listen, then after you say that, which is okay, but tell me what your short position is, because I guarantee you that you know what that's going to actually do to the market. When you hear Jamie Dimon come out and talk about the importance of rising rates, banks do well when rates rise. That's not a bad thing for a bank. But let's just, a quick setup, and then I'll come back finally to your question about earnings. A quick setup is when interest rates rise, okay, there are consequences in the market that tend to not affect people on Wall Street. In fact, Wall Street will do great when rates rise. The impact is middle America. The impact is the average person. The impact is, it's on your student loan rate going up. It's a variable rate on your home that goes up. It's the auto loan that you're going to want to go out and get. It's credit card rates being able to now be pushed up. A lot of things, all the moratoriums on rates, of course, should end soon when COVID ends, or on different lending like student loans. But it tends to be the middle and the lower part of the class that have more debt, less income. And so then the second question is, well, you got to bring down the cost of goods. Everybody's worried that bread and eggs and milk are too expensive. Well, how much does rising rates, a quarter or half a point raising rates, even a full point over, bring down the cost of goods? Because I'm not talking about overpriced Ferraris and Lamborghinis or yachts and luxury homes. That stuff will adjust to some extent when rates go up. But those people buying those don't necessarily need to borrow to buy that stuff. And so the people that are borrowing to buy stuff get hurt. And you go, okay, so milk goes down 10%, wages go up no percent, because if all these companies get crushed, they're not going to pay people more as the market gets crushed and these companies go into a worse cash position. Because like you said, the value companies that don't need to borrow, that have income and you're going to get compression on their earnings, though they're still going to make less. Revenue is going to drop. And then the growth companies that are doing all the hiring, a lot of higher paid, better jobs, are going to slow hiring. They're going to be looking at raising money, potentially offerings that are going to push their stocks down further. It's a really kind of vicious cycle. And so I'm going to give you a second to comment, because then I want to talk about what's going to happen to tech with interest rates. But as I see it, I don't think a lot of people are really reflecting. China actually lowered a key interest rate on its mortgage just the last couple of days. And this is really interesting to me, Al, because I said, you know what, China's almost just like, forget it. Let's run it hot. Let's keep running it hot. Because the stuff at the top of the echelon, those people have so much money, they don't care if that boat costs more. That's why we're seeing, like I said, you can't find a Lamborghini right now. You can't find one because the people with money have money and they're going to buy it, whether it's $500,000 or $1 million. They just don't care. The person that's being affected by the overpriced milk, though, that is a real impact that I'm not sure how raising rates is actually going to help. The idea of raising rates help, but China, if they keep doing this, and by the way, with all their labor, they're not going to incentivize companies to repatriate. Al, they're going to keep us looking to offshore because we got to keep costs down to keep earnings high. It's a terrible cycle.
It's a very interesting. So I did not. You surprised me with this one. This is like Up with People. Workers unite. I don't disagree. Now, listen, you're right. You're absolutely right. But various jokes abound, right?
Careful.
You mean the yield on my savings account won't make up for the mortgage rate increase?
I'm saying the 25 cents you're going to save on your milk won't help when your mortgage goes up 3 percentage points.
Oh, I know. Right, but won't my savings account suddenly start yielding 0.5%?
Yes, but you won't have anything in it.
That's the problem.
You got to have money, man.
Inflation is a problem, right? Inflation eats away at the value of people's earnings, old people's savings, retirees, people on fixed income. Inflation is a bad deal. We don't want inflation. So it's true that we need to do something to deal with inflation. Now, the fact is rates are like, a hammer, and they hurt different groups disparately. I absolutely agree with you, but we got to get a handle on this inflation. Now, this brings us to the debate over whether, we get political. It's the Joe Biden debate, right? Like, is the supply chain issues and Omicron shut the Toyota plant last couple of days, right? So, less cars, more high car prices. Car prices are at a record. So when all of the supply chain things get sort of worked out and absenteeism goes, down because, you got to quarantine for 5 days and nobody's showing up for work. It's a legitimate issue. So when the supply chain things, maybe the price of milk, price of cars, maybe that will go down. Maybe that will help. That's certainly what the administration hopes. And then that whole Build Back Better thing, right? Can you spend $1 trillion of government money, which is our money, to lower inflation or make people better off, right? So there's you got to look at the child tax credits in there, trying to help out the middle class, get to work, lower the cost of their kids' daycare, all that sort of stuff. Huge issue. What am I saying? You got to deal with inflation. You got to. Inflation, bad news. We don't want, and you can think about it in extremes. Now, we'll never get there. I used to work with a guy from Brazil, and he was there in the 80s and whatnot. And I said, what is high inflation really like? What do you, he's like, so my parents would get home on Friday with their paycheck. They would go out and buy anything. They'd go and buy an ironing board, a radio. They didn't need these things, but it was all that was on the shelves. And then a week later, the price would be up. That's what living in living in extreme inflation is like. We don't want inflation, but we can't kill the demand engine. To your point, you can't kill this demand engine, or else you're going to have a bigger problem on your hands by the end of the year. It's tricky. It's a tricky situation.
Well, the fear of rates are going to start bringing some prices down on things anyway. When you get the supply chain fully running, which we need to do, you'll get more supply, and that glut of supply will naturally bring down some of the pricing on things like electronics and vehicles that have been stunted, right? Because you're not actually talking about inflation at this point. You're really just talking about a lack of supply that's causing, limited supplies on a lot of specialty items to go through the roof, like, the newest Xbox or brand new, cars, high-tech vehicles. They just can't make them, and they can't make enough. And then, of course, this all goes back to semi. So it's good to see Intel putting up a plant in Ohio, spending the money. We need to repatriate. We're down to 12% of our chips being made here in America. We need to get that back towards 30+%, which is what Pat Gelsinger from Intel said in this decision. We got fabs going in Ohio. Now we got fabs going in Arizona. We've got fabs going in Texas, Samsung, TSM, Micron, Intel, all building. But this is going to take a few years. This isn't like, hey, we're going to just start making more chips. But of course, that is a big difference maker. With the time we have left, Al, let's talk about your question. Let's talk about what's going to happen with earnings. By the way, I love this macro stuff. This is huge. And I think people understanding this is really important. But the earnings thing is going to be really interesting to me, because when I started, and I was telling you about November being kind of the start of the real growth downfall. That's when growth names started really plummeting across the board. But now here we are in January. Well, basically what we're going to start is an earnings season that will start with tech next week. You're going to have the Amazons, the Alphabets, the Apples, AMDs, Intels. They're all coming up really quickly. It's going to be based upon a quarter that ended at the end of the calendar year. My expectation, and by the way, Netflix somewhat validated this, although Netflix isn't really the core tech I'm thinking about right now. I'm thinking about big tech.
The funny thing with Netflix is it made a great acronym. That's why it got stuck in FANG.
Yeah, it's too small.
You couldn't make a good word without the N.
It's too small, but thanks to Facebook going Meta, they went Mama now, right? It's the Mama. But in all serious, earnings are going to be good. I actually genuinely believe demand for tech is extraordinarily high. On the enterprise side, if companies are going to start to look into the need to, and by the way, not financial advice, just being very clear, earnings are going to be good because the demand for tech hasn't subsided. The demand for semiconductors has not subsided. The demand for software has not subsided. The demand for PCs has not really subsided yet. The demand for in gaming, as we saw with the premium Microsoft paid, the demand for just all kinds of different technologies has stayed and remained strong. And by the way, the solution for a lot of companies that are going to be put in a difficult situation if they are rate sensitive is going to be more tech investment. Meaning, if you are an industrial company, if you are a real estate company, you're going to be looking at software. You're going to be looking at AI and analytics. You're going to be looking at tools and automation and technologies that are going to enable your business to run more streamlined. Unfortunately, who gets hurt again are the employees, because companies are going to look and see, how do we minimize what tends to be most every business's largest expense, which is human capital. And so we want to implement new software, new solutions, new data and analytics tools. We want to do machine learning and AI. We're going to move workloads to the cloud. We're going to get out of CapEx and we're going to do more OpEx, which, by the way, going back to Microsoft 365, was a huge winner for any cloud company to realize that one-time licensing is not nearly as good as getting people to pay at a discount rate, but a premium on a monthly basis for this software forever in perpetuity. And so I think we're going to see really strong earnings. You're going to see continued growth in enterprise. You're going to see continued growth of consumer technology. Where you might get hurt a little bit is going to be things like PCs bought by consumers. You might see a little bit of a slowdown in personal technology buying. But I actually think that's probably a quarter away, which is why I was going to tell you the biggest lookout isn't going to be earnings and revenues. You saw with Netflix, their earnings and revenues were great. They got crushed on guidance. And so this quarter, I think the street is going to be all about the guidance. I think the companies are going to come in good on earnings. They're going to come in good on revenues, Al. But then what's going to happen is everybody's ear is going to be, if they start to show any sign that they're not confident that what is ahead in the next quarter and the next year is good, you're going to see selling. You're going to see them selling the news that effectively we are no longer confident that whether it be Amazon's forecast, whether it be Alphabet's ad forecast, if they think that it's slowing at all, that's the sensitivity point we're at right now, is that I could see one more big wave down, especially for those big names that really haven't been hit yet, if they're going to show weakness. My feeling is you could see another 10% down for those bigger names. And by the way, everything else will unfortunately probably follow it.
Yeah. You know, you stole my thunder. I was going to say, I unfortunately agree with you 100% and can add almost nothing, but I will do that. I will add anyway. I think earnings are going to be great. I think that basically, so I have a prediction too, right? Like, I think that we have a bumpy Q1. I don't think the world is ending. I think we can get through this. I think 2022 can be a good year. I'm an optimist, not financial advice. I'm often accused of being far too optimistic. But we have a bumpy first quarter, maybe first half, just because of what you said. I fear two things. In stock market terms, if you want to sound really smart at cocktail parties, I fear the back half loaded guide, right? I fear the earnings are going to be great in 2022. They're flat in the first half, everybody. We're going to make it all up in the last 6 months of the year. That sends traders and analysts over the edge. The back half loaded guide is the disaster of all disasters for Q1 earnings. That is what I fear. And right, it would be a back half loaded guide because it's like, oh, we're seeing some cost inflation now. We're seeing some problems in our supply chain that are going to take X billions out of our earnings stream for the first 6 months. But don't worry, it'll all be resolved by the second half of the year. That's sort of the worst thing that could happen. Or to your point, like, oh, the ad market, it's a little wonky right now, but by the second half of the year, it's going to be great, right? So, guidance always matters. It probably matters more this time because of the state of the market and because of the nervousness about inflation and rates. So it's going to be really interesting. I pulled the newsroom. I pulled Barron's newsroom to add value to this broadcast. And it actually is interesting. I'll tell you why it's interesting. Are earnings enough to get us out of this funk, right? So will strong earnings, decent guidance, end the tech wreck? The newsroom was split 50-50, which is half of them were like, earnings are going to be great. We're basically back to valuation levels before Omicron started to hit tech stocks, like you said, in November. That's a fair price to pay for a lot of these high quality companies. The business outlooks are good. We're good. Earnings as a tech wreck. The other half was like, I'm worried about guidance. We don't have clarity on rates. The macro is going to overwhelm whatever anyone says. The selling will continue through the first quarter of the year. What does a 50-50 split means? It means nobody knows what's going to happen.
Yeah. Well, if we did,
it's important. Everybody has to know all the time, but to know that the people that look at this all day long are basically like, we'll see what happens. That's not always the case. Sometimes there's a consensus, and oftentimes the consensus of the crowd turns out to be right. It's a bit of a scary time at the moment.
Although they do say that when you really start to feel the fear is usually the point when there is going to be a turn. Like you're really starting to feel people like that were saying this can't go any lower, and now it is, and they're starting to go, I'm worried. And that tends to be when the algorithms pivot, is when people really start to feel uneasy. Now, having said that, like you said, we have a long way from an index standpoint before we'd really be down to even close to where we were in 2020. These things have made so much of a run, but so much of it is weighted towards a few names. And what I'm saying is, if you actually look back, a lot of gains, like a Zoom, I mean, good Lord. I mean, they're hugely up from where they were in March 2020. They're down 75% from where they were at their highs. And by the way, all they've done is grow. They grew triple digit percentages and then backed it up with mid double digit percentages after growing multiple quarters at triple digit. And people are like, I don't care. I'm going to just absolutely crush this name. And nothing has changed. They got great recurring revenue, strong fundamentals. They're profitable. They're doing $billion+ a quarter. So, I think what needed to happen is a little bit of a resetting, a little bit of a cooling. To your point, the split newsroom feels like actually one of the better answers I would expect, because the fact is that people saying they don't know is probably takes a little pride. It takes a little bit of maturity, maybe is the right word, to be able to kind of come out and say, I'm not really sure. Now, one thing I will ask you, though, I'll just throw this, I'll lob this grenade over to you and ask you this question, is if it stays this bad, and again, this is like the worst January ever, maybe, for the markets right now.
For the NASDAQ, could be the worst January for
the worst January ever for tech in the NASDAQ, because most of the tech is on the NASDAQ. And like I said, that follows a few months that already was not the indice, but a lot of the names were already being sold. So those names are hit even harder. What happens in March when the Fed meets if the markets have not shown some real recovery? Can they still go ahead and raise rates, or are they going to have to hold off? I mean, how much could a market stall? Because you start to talk about stagflation, you start to talk about a true recession, because now you've got a market that's been capitulating, you've got higher rates, you've got people more afraid to borrow, you got banks tightening, you got all kinds of different issues all happening at the same time. Plus, we still haven't overcome this virus. It's still slowing down mobility. You've got health issues. We've got numerous macroeconomic force issues with Ukraine and Taiwan and China. We're on the edge of war in places where most people probably don't even know that. I mean, there's a lot going on, and all of a sudden you put us in a recession. So you're trying to get inflation down, but the alternative.
Yeah, I mean, man, you seem down. We're gonna have to put you in a better mood later.
What are you talking about? I'm smiling.
I know. The answer is, in that scenario, the answer is rate hikes will be halted, and prices will probably be coming down. Right? In some sort of recessionary or dramatic economic slowdown, prices are certainly going to go down. There's so many. There's great anecdotes sort of all along the way that sort of add up to the headline numbers, right? Like car prices are off the charts, and they're off the charts for a couple of reasons. There's a big supply chain constraint, chips, and also people are doing just fine and they want new cars. And the rate increase hurts one of those things, and the supply chain, building the fab helps the other thing. So, if everything goes well and it normalizes, you get a little relief on prices, inflation, and that removes some of the pressure on the Fed to sort of, worry about hitting the economy over the head with increases. So that's sort of the positive side of that coin, right? But, in your side, like if it's recessionary and things are really starting to slow down and COVID is persistent, then I don't think that they're going to remove, economic stimulus. The one thing, everything, I don't know if that's a good answer, but the one thing about this, every recession, every downturn is a little different, right? There's always different reasons, and history never repeats, it rhymes. Like, from my perspective, right, in sort of industrial land, everything with smokestacks and wheels, absenteeism has been a huge issue. It's not people like, the Great Resignation or whatever. It's not like people don't feel like coming to work. It's that, your neighbor gets COVID, you're with your neighbor, you got to test, you get a test, you got to be out for 5 days, the plant's going down, the plant's not running well. So that, if absent, what am I saying? If absenteeism and these sorts of supply chain pressures continue to pressure prices, I think that, the Fed or whoever can credibly say, listen, we have to support the economy through COVID. It's going on longer than we thought, without worrying too much about runaway inflation in the long run. So how's this for a summation? There are so many moving parts right now that, if the market continues to sell off and prices start to weaken, you could absolutely get a more accommodative Fed into March and into the rest of the year. But if demand is strong and prices are a little more stubborn than you want, you can probably get some rate increases without ending, the party that has been the stock market for the last few years, right? So they're trying to thread a needle. It's probably a more difficult needle to thread than it has been in the past. But if you want to be optimistic and believe that they're not incompetent, it's going to be okay. It's going to be okay.
Well, the market does tend to take care of itself. That's an argument about governance versus free markets. They do tend to, when things do become priced well enough, money comes back in. I've heard there's a few trillion on the sideline right now waiting to come back in right now. That could obviously quickly send the market back into a bit of a bull run. The other thing, though, too, is you did mention this, is inflation will be fixed more by supply chain corrections than we're necessarily letting on, because, like I said, many of the items that are the biggest indicators of our inflation are also tied to the fact that we can't get supplies, which is driving prices through the roof. Homes, cars, even the shelves at grocery stores, we can't get the goods. And so if we had enough of the goods, the prices would naturally start to come down a little bit more, kind of like we all know from oil with gasoline, when, it's the same kind of situation.
So again, you got to make predictions to be cool. I will say, I believe in the supply chain, driver of inflation is significant. I'll say that half of the inflation that we're currently experiencing, right? Highest inflation since 1982. I will go and say half of it, roughly 4 percentage points is supply chain. And just getting that back to normal will significantly ease the pressure on the Fed, the economy, companies going into the second half of the year. Now, I just backed myself into the second half is going to be better than the first half. So there's no way around this problem that almost of our original question and your first point about guidance, there's almost no way around the fact that you're not going to get satisfaction. This is my big concern. You're not going to get satisfaction from the companies when they tell you how the first quarter is going to go. They're going to hedge. They're going to be like, yes, costs are up. They're not going to be like, it's over by March 31st. Freight costs are down. The fabs have opened the gates and the chips are falling out of the front door and we just pick them up and put them into phones. It's not going to be like that. You're not going to get satisfaction, even though I remain optimistic.
Well, we'll just about wrap it up there. I'll say my prediction is tech is going to have a great quarter. Guidance is going to be the hedge. And so good guidance could yield a better recovery. Weak or strength or significant concerns in guidance could actually lead to another leg down. I think that's going to be what we listen for. We got that clue with Netflix yesterday. People are nervous and they're waiting to see what happens. Al Root, tons of fun to have you on. We'll do this again in a month. And, at some point in the future, we'll come back to some of these predictions, because that's the one thing most of us never do, is actually say, did we get it right? So always smart talking to you, my friend.
Oh, thank you. You too. I think we got Q1 right. I think we hammered it. I think we know exactly how the stock market's going to work.
We're going to share the crap out of that. We're going to reshare it and reshare it and reshare it. And we're going to find the seconds and say, this was the second when I said something super smart, and we're going to tweet that stuff. So all right, everybody out there, check out Al's column. Al writes on Barron under Al Root. Great coverage, especially if you want to follow automotive, smokestacks, and wheels. But one of the smarter tech crossover guys. Definitely enjoy talking to him all the time. We're going to do this more often. Again, thanks for tuning in. We'll see you next time. Bye-bye.
Thanks, Dan.